time now to welcome on board Steve Brice, the Chief Investment Strategist at Standard Chartered Bank as well. Steve, hi, good morning. Thank you so much for making time and speaking with us. Well, big headlines coming in from the global markets with UBS finally inking that deal to buy out Credit Suisse for around $3.2 billion. What's your initial thought to that? What's your take on this deal? And will it really stem the contagion effect that the street was worried about?
Well, I'm not sure it will, in the immediate future, stem all the contagion risks that we have around the world, right? So, I mean, obviously, we've still got the situation in the US regional banks as well. It does remove a lot of uncertainty, I guess, from a banking sector perspective in Europe. So it's certainly a positive step, I think, in the big picture. I guess there's two things that we would sort of be looking at from a banking sector concern perspective. Firstly, what does this the deal actually mean for investors' views on different asset classes? Obviously, the AT1s are particularly important in that regard. So it'll be interesting to see what happens when Europe opens there, to see if there's any contagion or sell-off in other areas of that space. And then secondly is that situation in US regional banks, a lot of focus at the moment on their commercial real estate exposure, particularly in the office space, to see whether the liquidity concerns that we've had over recent times morph into something more concerning on the solvency side. Now, that's obviously, we're a long way from that at the moment, but it's something to keep an eye on, I think, before we can sort of signal the all clear from a global financial system perspective.
Right, Steve, morning. What's the expectation then from this very eventful week? We've got a lot of data points lined up, but in particular, do you think that the US Fed is potentially going to pause on those rate hikes and that it is going to be a 25% rate hike on the cards this time, a 25 basis points rate hike this time?
25% would be quite a surprise for markets.
Pardon me. It's a Monday morning, you'll have to excuse me.
So, look, I think our central scenario is that they'll do 25 basis points, but I mean, it can vary on a day-to-day basis, right? Depending on what's happening in the, in the markets, things are very volatile. I mean, if you look at the Bank of America Merrill Lynch Move Index, the bond volatility index, last week we broke through the COVID-19 highs. So that was a big move. Now, we actually went briefly above the high in 2009, but not yet anywhere near the 2008 levels. So the amount of uncertainty on the rate outlook is huge at the moment. And I think what happens in the next 24, 48 hours will be really important for the Fed. But central scenario, 25 basis points. If they were to do 50, I think that would be really bad for market sentiment, given the financial fragility out there at the moment. But I think the Fed probably understands that.
So, Steve, what's the recommendation then at this point of time? How should one, change their portfolio or make incremental investment at a time like this when the markets are actually taking a bit of a slide? You might call it as a buy on dips market or something that you should stay away. Is there more downside coming for the equity markets?
So, I mean, I guess our views haven't changed that much in recent times. So we're pretty defensive in our portfolio allocations at the moment. So if you were to summarize that, we'd say we're overweight bonds versus equities, overweight investment grade bonds versus high yield bonds, and overweight Asia relative to the developed markets. So those are the sort of the three ways that we're positioned in this environment. Most of those factors probably playing into that view at the moment. Obviously, we saw easing from the central bank in China at the end of last week, which just further reinforces our view that they're in a separate part of the economic cycle. So, that's our positioning, and we're pretty comfortable with that at this time.
All right, let you go on that note. Thanks very much, Steve, for taking time out and joining in and sharing with us that perspective on the global markets.